welcome to the Business Standard Morning Show. I'm Kanishka Gupta. Let's have a look at the stories for the day. Reliance Consumer Products, the fast-moving consumer goods arm and a fully owned subsidiary of Reliance Retail Ventures, launched its consumer goods brand Independence in Gujarat on Thursday. The launch puts the company in direct competition with Adani Wilmar, Tata Consumer and ITC, who also have a portfolio of staples and processed food. It is among the latest business verticals that had the Ambanis enter Adani's turf and vice versa. Is FMCG then the new battlefield between the Ambanis and the Adanis? Here is Debargia Sanyal's report.
On Thursday, Reliance Consumer Products Limited launched its packaged goods brand Independence in Gujarat. With the move, the fast-moving consumer goods arm of Reliance Retail Ventures or RRVL entered the home turf of their rivals Adani Wilmar. FMCG brand Independence will be a fully owned subsidiary of Reliance Retail, which has over 12,000 stores across the country and is one of India's largest retailers. Reliance will also push the products through its distributors and Kirana networks. And affiliates operates more than 16,500 stores of its own. It partners with over 2 million merchants across grocery, electronics, apparel, pharmacy, lingerie, home and furnishing, beauty and personal care. RRVL also operates the omni-channel business through JioMart, Ajio, NetMeds, Zivame and other online channels. It reported a consolidated turnover of 1,99,704 crore rupees and net profit of 7,055 crore rupees in the last financial year. The entry of the Ambanis into the FMCG sector therefore will be keenly watched by its biggest competitors, Adani Wilmar. Harish Byju, brand guru and founder of Harish Byju Consults, believes
in come two behemoths, Adani at one end and Ambani at another. When you have big ambitions, you're willing to bleed in the early days. And the ability of both these enterprises to bleed to create market share is very good and very big. Because people do know that both these players have got deep pockets, deep ambitions, and the wherewithal to do a long play in the Indian market.
Sandeep Goyal, Managing Director, Rediffusion, also anticipates a major churn with the entry of Reliance in FMCG.
So from the perspective of the biggies who are already entrenched in the market, what do you do when you have the elephant enter the room? Your rival is extremely well resourced. So, normally when you're fighting newcomers coming into the market, they don't have the resources. The second thing that Reliance has, which traditionally has never been part of that battlefield, is they have their own retail today. So they have a last mile capture, which traditionally any challenger brands have never had the advantage of. Now, the third thing is they've already been playing in that space with private labels.
However, the move will not be free of challenges for Reliance as well. Byju explains.
We are a nation of village shopkeepers. Any tiny village you walk into, with a population of 4,000 or below, has about 6 retail outlets. And how do you go to those 6 outlets? How do you reach out and place your stocks on those 6 outlets? How do you get money out of those 6 outlets? How do you service them week on week because they don't have the capability of keeping large inventories? Now, this is the real challenge.
Goyal believes Reliance will have to choose its battle.
Even if you are Reliance, you got to choose your battles. you will decide which part of the product portfolio am I going to focus on. Am I going to take on, say, all of these guys in tea? In which case, you spend a little bit of time and energy just fighting tea and ensuring that you get to market supremacy in that product line.
The FMCG sector, which is estimated to employ over 3 million people, is among the latest in a long line of industry sectors that the Ambanis and Adanis have operational investments in. Their business interests range from port management, telecommunication, renewable energy and telecom, to natural gas, retail, and infrastructure. Experts agree that Reliance's independence will pave the way for some interesting developments in the sector.
While the big boys of India Inc. are preparing for a long play in the FMCG market, EdTech startup Byjus has landed in troubled waters. Creditors of India's most valued unicorn are pressuring it to sell off its US assets to repay loans. At the same time, Byju's harsh working environment has also come to light. Our next report by Tushar Verma dwells on whether Byju's is still facing the growing pains of a startup or is it spiraling downhill.
EdTech startup Byjus has been asked by lenders to sell off its assets in the USA, worth $500 to $800 million to repay its $1.2 billion loan. The development came at a time when Byjus reported a loss of 4,588 crore rupees in the fiscal year 2020 to 21. Is Byjus then still facing the growth pangs of a startup, or there's trouble around the corner?
I think Byjus is a case of too much, too fast, having grown at a stupendous pace, having taken capital, not being frugal in the usage of the capital, not being smart about the usage of the capital, just pursuing valuations for the sake of pursuing valuations. This was symptomatic of capital being available easily across the globe, not just in India. And the VCs and PEs were demanding that companies grow fast, irrespective of whether they had put in place processes, whether they had paid their creditors, or ensured that some of the basics of running a business were in place.
Luckily, the liquidation demand came from the minority lenders. Unless at least 51% of all lenders to Byjus agree, the loan terms will not change. Negotiations are underway, and Byjus is unlikely to agree to some of the new terms. The lenders have reportedly hired Houlihan Lokey, a global investment bank, to represent and advise them on loan terms. Byjus, on the other hand, have hired financial advisory firm Rothschild & Co. to represent itself in the talks. Business Standard reported that if Byjus is unable to repay by liquidating its assets, the lenders may take legal action. But what has led the $22 billion valued EdTech major into troubled waters? Byjus has been exceptionally late by 18 months in filing its annual financial reports for fiscal 2020 to 21. It has still not filed its 21 to 22 financial reports. One of the terms of the loan was to file the financial report by September, which Byjus did not adhere to.
Last year, funds were available easily, whether it be equity capital or even debt capital. So even the lenders did not take sufficient collateral in terms of the standard collateral. So the lenders, whoever has lent to Byjus, has probably shares as the collateral. And since valuations are marked down, etc., we are not even sure, based on the media reports, whether Byjus has been servicing the loan, even paying the interest payments which are due on the loan. So from that perspective, I think it is right on the part that the lenders will either ask them to service the loan or pay off some assets to pay back the loan or service the loan.
For the same reason, the edtech major was unable to get a rating for its $1.2 billion loan, which was expected within 9 months of raising the same. The reported losses have also forced it to rethink sponsorship deals with BCCI in an attempt to cut down on media expenses. Recently, it also announced the firing of 2,500 employees to restructure its operational costs. Troubles for the unicorn did not end there. Byju has also been making headlines for its toxic work environment. In an investigation by Context, a media platform of Thomson Reuters, it was revealed that some managers forced employees to work for more than 72 hours a week. In its report, Context said that employees at Byju were not allowed lunch breaks and time offs at work. Reports also point at Byju's salesperson tricking customers into long-term EMI payments to finance its expensive classes. All these dented Byju's image amid high losses and pressure from creditors.
Let me put it this way, that whenever a new enterprise actually enters a market and wants to ramp up fast, these kind of issues typically happen. There are two dimensions to it. One is the internal dimensions within the organization, where typically employees are made to work harder. Employees have to stretch themselves much beyond the normal work hours possibly. The external dimension is, what does it do to the environment where people are knocking on homes and saying that I know you have a kid possibly has issues in math and biology, and which parent doesn't want their child to do better? And oftentimes, buys the product as well.
Business Standard had reported that the creditors asking for liquidation of US assets are activist investors. Such investors usually take positions to restructure a company's governance to make it profitable. But with recent developments around the company, it remains to be seen how investor relations play out.
A lot of creditors are going to do a lot of things. A lot of back-end stuff is going to ensure that the screws are tightened in terms of targets, in terms of efficiencies, in terms of profit margins, in terms of sales. These are internal back-end issues which a typical startup, unicorn, decacorn faces. I do believe even this shall pass. But till it passes, it creates a negative image on the brand for sure. There are many things which only investors understand, and I think it should be kept quiet within the investor's iron curtain. You are not an entity who can get into the market and talk about all the great things you're doing to bring efficiency into a startup, because the startup is already going through its own problems. And yes, it creates negativity for the brand.
Chief Executive Byju Ravindran has recently said that the worst is behind them. The company is hoping to be profitable from 2023. It is also looking to hire a full-time Chief Financial Officer, which is also one of the terms proposed by the lenders seeking liquidation of assets. As the highest valued startup in India, Byju has come a long way. If the unicorn aims to spread its wings, analysts believe the key lies in its effective allocation of capital, while investors should allow it more time and space to grow.
Moving to the markets, global equities were startled last week after the US Fed and European Central Bank warned of a long, painful period of higher interest rates. They also cautioned investors against economic slowdown. This comes just a week after the Reserve Bank of India expressed concerns about the sticky core inflation back home. Given this, will the markets witness extended correction this week, or will they bounce back? Rex Cano answers these questions.
A surprisingly hawkish pivot by the US Federal Reserve, along with the European Central Bank and Bank of England, crushed global equities towards the end of the previous week. All three banks raised their benchmark interest rates by 50 basis points each and warned of forceful monetary policy response in 2023. Among the lot, Fed announced that it saw benchmark rate peaking higher than expected at 5.1% next year. It also suggested that inflation may remain stubbornly above its 2% target till the end of 2024. 2024, thus ruling out any hopes of rate cuts until then. The spillover effect hit India as well, with the benchmark S&P BSE index cumulatively sinking over 1300 points during last Thursday's and Friday's session. For the week, the Sensex ended 844 points lower at 61,338. The NSE Nifty 50, meanwhile, tanked 1.2% to 18,269. In the broader markets, the BSE mid-cap and small-cap were down by up to 1.4%. Going into this week, analysts expect markets to consolidate further and track global cues amid no domestic events. Navin Kulkarni of Axis Securities, for instance, predicts a limited upside in equities this week on the back of stretched valuation.
The market has seen some correction in the last 2 days after the actions by the Federal Reserve, which essentially talked about interest rates and inflation challenges persisting. This will have an impact in the forthcoming weeks. Market valuations for India are not cheap. The inflation continues to persist globally. There has been some decline in inflation, but it is still reasonably high. Apart from this, market valuations have also moved up, which provides little comfort from current levels. So, taking this into consideration, we expect the market to remain range bound for some time, and more importantly, in the next week, there could be some corrective actions.
Technical charts too are flashing warning signs. The frontline indices have dipped below their short-term moving averages, with the 30-pack index eyeing over 3,000 points downside if it breaches key support levels.
For Sensex, SMA 21 was at 62 to 285, and for Nifty it was at 18,525. Both the indices have broken this key level, and any consecutive close here on would mean there is a selling pressure, or market could see a sideways trend wherein all the efforts will be made to absorb all the selling pressure arising at higher levels. The next support for Sensex is at 61,000, and for Nifty it comes to 18,100 level. Only upon breaking these support marks, Sensex and Nifty can see further downside to 58,000 for Sensex and 17,700 for Nifty. In terms of Bank Nifty, simple moving average 21 comes to 43,190, and only breaking this support mark, it can further slide to 42,500 to 42,700 levels.
That said, any positive news flow may trigger up move towards the immediate resistance zones. These are 62,285 for Sensex and 18,525 for Nifty. On Monday, market participants will focus on primary market activity. The 15,000 crore rupees IPO of KFin Technologies will open for subscription today and close on Wednesday. The price band of the offer is fixed at 347 to 366 rupees.
From the market outlook, let us move to the outlook for Indians living in the US. Indian nationals in the US and applying for the permanent resident card, commonly referred to as the green card, have been facing long waiting periods, often decades long. But now, there is a silver lining on the horizon in the form of the Eagle Act. What is the Eagle Act and how can it help? Raghav Agarwal decodes it for us in this report.
Thousands of Indians apply for permanent residency in the United States every year. The green card, officially known as the permanent resident card, is the final stamp stating that the person is now a permanent resident of the US. However, there is often a long waiting period to acquire permanent residency. One of the primary reasons for the delay is the 7% per country cap on the employment-based immigration visa in the US. To overcome the delay, the new Equal Access to Green Cards for Legal Employment Act, or EAGLE Act of 2022, was introduced in the US House of Representatives earlier this year to propose removing the country caps. It also aims to raise the cap on a family-sponsored visa from 7% to 15%. On December 14, 2022, the proceedings on the bill were postponed in the US House of Representatives. The primary aim of the EAGLE Act is to shift the basis of giving the green card from the place of birth to skills. It also benefits people from India seeking a permanent residency in the US, as they will have to wait for shorter durations. Major companies including Amazon and Intel have expressed their support for the bill. According to research by US think tank Cato Institute, the bill would raise the average wage of an employment-based immigrant by 12% from $95,534 to $107,126 per annum. Faster processing of the citizenship application will also help immigrant workers to get protection from exploitation, as they would not be completely dependent on one employer for their legal stay for an extended period. The Act has several clauses that address the fears of the Americans. The employers who hire foreign workers will have to advertise the jobs to American workers on a searchable Department of Labor website for at least 30 calendar days to ensure American workers can get the first crack at these jobs. It also offers whistleblower protections for employees to report illegal employer behavior to the US government. The Act will also make it illegal for jobs to be advertised as only available to H-1B workers. A green card holder can apply for US citizenship after 5 years of permanent residency. They need to renew their green card before applying for citizenship if it is set to expire in less than 6 months or has already expired. Once issued, a green card is valid for 10 years.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The Eagle Act reportedly ensures US employers justify the wages offered to immigrant employees. So, an employer can no longer undercut American workers by paying low wages to immigrants. That is all for today. For more news, views, and insights, please log on to business-standard.com. For more news, views, and updates, subscribe to Business Standard on Google Podcast, Apple Podcast, and Spotify. Also follow us on YouTube, Vimeo, Instagram, Twitter, Facebook, and LinkedIn.